Just imagine all there. Okay, go ahead and run the video. Day 3 of the 16th annual MIT CDOIQ Symposium. This is track 1, environment, social, and governance. Better data insights enabling companies' ESG goals to ultimately benefit society. I'm your track producer, Robert Lutton, Vice President of Sandhill Consultants. I'd like you to welcome to this outstanding session, which is called Investing in Impact, Integrating ESG with Investment Management. Now, before I introduce our panelists, I do want to tell both the audience here and the virtual audience that we will look back on this session and say, these guys were right. So this is your key session. You're going to learn a lot of great information here. But just, first of all, this session is being recorded. So the presentation will be available online. You can actually click on them tomorrow. I know some people already do that. They'll watch yesterday's sessions. And they'll be available after for the next couple of months online. And then what we'll do is we'll move them to the CDOIQ YouTube channel after that in 3 months' time. So there is a fair amount of people online. I've already checked in. Thank you for dialing in. Thank you for giving us the time. Please do use the Q&A feature online to ask your questions. We will monitor that, and then I'll be able to update the panel. And also for our audience live here, we've got 2 microphones either side, so please use that, and we'll make sure to ask the audience on that. So, this morning, I've got the delight, it's really a delight, to introduce 2 of the panelists. Let me introduce Harish Arora, who's the Managing Director of EY, so welcome, and then Anisha Khosla, who is the Senior Data and Analytics Consultant, EY. Yeah? So Harish, I'll pass it over to you, okay?
Thank you. Actually, we'll have Anisha start, and then I'll jump in.
Thank you all for tuning in online and for joining in person. So Harish and I worked at EY, and we focus on supporting financial institutions tackle their data problems. So whether that's developing a data strategy, whether that's understanding what data they have at their fingertips, how to utilize it, this is what our primary focus is. And for the past couple years, we have been focusing on ESG, helping develop an ESG data platform for financial institutions. But the interest in that platform has really ticked up in the last 18 months. And so the purpose of our presentation today is to kind of delve into what exactly, where did we come from with ESG data, and what does the future look like, and how can your organizations think about ESG data moving forward? So to begin with, I have selected this quote from Sharon Burrow that I think kind of encompasses the importance of what we're talking about here today. We all need to work together because there are no jobs on a dead planet. There's no equity without rights to decent work and social protection, and no social justice without a shift in governance and ambition. And ultimately, no peace for the peoples of the world without the guarantees of sustainability. This is what ESG data is about. It is about looking at what is the impact that we are having on our planet, on our communities, understanding and quantifying that impact, and then using that in order to make decisions moving forward in order to ensure that we leave a better world for generations to come. So at a high level, what are we talking about today? We're going to be starting with what exactly is impact investing, ESG impact. These are a lot of words that get thrown around, kind of deciphering between them. And then from an investment management standpoint, understanding how looking at ESG is not the opposite of focusing on financial returns or alpha. These actually are complementary ideas, and so we'll delve into why that is. From there, we'll move into what are the challenges that we're seeing from our clients with ESG technology, with ESG data. And from there, how do you integrate ESG data within investment management or within your organization in spite of those problems? How do you move forward? So to begin, defining impact investing. So here are some numbers on the screen. You don't have to read all of them. You can pause if you want to later on. But I wanted to call out a couple. First, in the middle on the top, that $500 billion. There was a Bank of America study that found that ESG-related failures, meaning a lack of looking at ESG risk, led to $500 billion of lost market value. That's a lot of money that's being left on the table just because we're not looking at what we should be looking for. 92% of investors in the bottom right-hand corner, 92% of investors in the last 18 months said that they made a decision that they saw benefiting from the green recovery. Since COVID has happened, people are more aware of the type of impact that things like social governance, environmental factors can have on their investment decisions, and we're seeing that in these survey results. But there's still a lot of room for improvement. Those numbers in the middle, the $6 billion, the $133 billion, that's the amount of money that needs to go towards nature-based solutions in order for us to have any hope of meeting climate change targets by 2050. That's a lot of money. So, impact investing and sustainable investing. What's the difference? Why are we talking about both of them? What exactly are we talking about when we talk about each of them? So impact investing has been called thematic investing in the past. It's this idea that you are making an investment with the intent of generating a positive impact. So I'm investing in, a company that produces clean energy. That is making an impact on the community and the world around me. That is an impact investment. A sustainable investment is a more broad term. It is this idea that we are looking at ESG-related criteria when we're making an investment. It doesn't need to be an impact company. Maybe I'm investing in a retail chain. But when I'm looking at that retail chain, I am looking at what is their environmental footprint? What is their contribution to the community? What is their internal governance? What does that look like? Some examples of the types of things that you might be measuring when you're looking at ESG-related data can be seen below. So within environmental, as I mentioned, what is your emissions impact, your waste management policies? What are you doing on the social side about human rights, labor rights? What are you doing in terms of health and safety for your employees and for your community? Governance, what are your shareholder rights? What is your board of directors and what is their level of independence? So why are we now talking about this, and what has been that shift in the last 18 months that has gotten people to start thinking about this more and will likely continue to get them to increase their thoughts around this process moving forward? So there's a couple that we've called out here. First is the demographic shift. From a financial standpoint, you are seeing a change in the number of people that have money and that are interested in these factors when they go to invest their money. As younger generations, including myself, are thinking about where do we want to put our money, we care about things like the environmental, social, and governance footprints of the companies that we are investing our time and our money into. Second, consumer expectations. When you're going to buy something in the market, again, these are things that I want to know. Is the company that I'm buying my products from, have they been involved in a child labor scandal? That'll probably make me think twice about whether or not I want to go and buy that product. Regulatory changes. This is coming on stateside, but in Europe, you can see significant regulatory changes and demands for data transparency around these different ESG-related data metrics. And finally, there's been a large shift towards just sustainability across all industries, focusing on how do we make our organization more sustainable, again, in the hopes of leaving a better future for the generations to come. So this slide is really meant to talk about past versus future. We've had ESG investing, thematic investing, impact investing for years, but we've talked about it differently than we're talking about it now. So in terms of when we thought about it before from a time perspective, previously we used to look at historical data. What was done in the past? Now we're looking at what is your organization doing right now in order to prevent future catastrophe moving forward? What sort of environmental protections have you put into place? What sort of policies have you put into place to promote more women, to bring more diversity to the forefront? From an investment process, it used to be you maybe had an ESG team that was very separate from the rest of your investment portfolio. Their focus was, okay, we're looking at ESG-related investments, thematic investments. We are kind of siloed in a separate part of the organization. Now it's becoming a key part of all of the investing that you're doing. Again, regardless of the type of investment you're making, we are seeing that our clients are thinking about what are the ESG factors that are related to that investment. From a focus, we've gone from exclusionary, we don't want to invest in guns, we don't want to invest in oil, we don't want to invest in anyone involved in a child labor scandal, to inclusionary. We do want to invest in people that have committed to zero emissions by 2050. We do want to invest in people that are actively taking a stance on promoting positive ESG qualities. Criteria, we've gone from, okay, this is an ethical concern, to what are you actually doing about it? There are tangible steps that have been taken, material steps. And finally, we've moved from a socially responsible investing strategy, so this is, we should be doing this is responsible, this is, we feel like we need to sustainable investing. This is the only way that we can invest in order to have a sustainable future moving forward. So again, this is kind of pulled from EY does polls of lots of different very senior stakeholders, and you can see the difference between 2018 to 2021. And obviously we all know that COVID-19 was kind of a major event that happened in between those years. But between 2018 and 2021, we see a huge jump in the number of people that say, or number of respondents that say that their companies conduct a structured, methodical evaluation of non-financial disclosures, meaning that they are looking for what are these non-financial attributes, things that you wouldn't think about on a balance sheet, things that are like your environmental, your emissions that you are releasing, what is your community impact, all of these ideas. This has been a huge increase in focus in the last several years. And 90% of the investors that responded to this said that post-COVID-19, because again, this is something that people didn't see coming. So if they were expecting it, or if they recognize that there are future events like this that could be on the horizon, how do you best prepare for it? 90% of people said that there is now a greater importance to ESG performance that they associate versus pre-COVID. So what does this mean in terms of investing, in terms of valuing a company that you work at? I really like this slide. On the left, you can see the current perspective, 3 boxes of how we currently look at a company. You've got tangible book value. These are things that you're going to see on your balance sheet, income statement. These are things that you can measure the cost of something that you purchase. Intangible book value. This is going to be things like a trademark, if you acquire a company, goodwill, stuff like that. And then intangible value, things that are not recorded on any financial statement. But when you look at the value of a company in the market, in the public market, you understand what you might be considering as part of that. It might be valued beyond what you have on those balance sheets, and that's as a result of intangible value. There was a study that was done by Ocean Tomo that says that over 80% of a company's value now sits in that white box, the intangible value. So what we're proposing is that the long-term value perspective, that third column, I guess, long-term value, you split that white into 2 buckets. The first is things that you can't measure, can't communicate. That's what we currently think of the entire white box as right now. But the second is going to be things that you can measure. If you look on the right side of the screen, you'll see some examples of what we're talking about there. Sustainability, the carbon footprint. How do we measure what a company's carbon footprint looks like and how it relates to others in that industry? What does that look like? What is their total economic impact? What is their customer satisfaction? Obviously, we want to invest in companies that have great customer satisfaction. That means that the customers like what they're doing and are going to keep going back. How do we measure engagement of the people within their organization, their loyalty, their leadership? So here you can kind of see how we like to think of the spectrum of impact capital. On the left, you have financial forward funds. These are going to be things that were traditionally, if you think of an investment fund, this is usually what it looks like. You don't really think about ESG factors. This was not something that was that popular up until, relatively recently. You are picking assets based on their ability to generate a return for either yourself or for your clients. Half a step up from that, you've got ESG aware funds. You're still not really selecting assets on the basis of ESG, but you're including ESG information in the disclosures that you're giving out to your clients. A step up from that is going to be your ESG value funds. This is actually a huge step. This is, you are thinking about the ESG footprint of the things that you're investing in, and that is helping to drive the decision of what you are going to be putting your money towards. From there, we've got high impact funds. So these are funds that are even further than the ESG value funds. They are actively going to look for options that prioritize impact. They're looking at the ESG metrics of whatever they're investing in, but they're looking for what is the impact that's generated. Impact-oriented funds, again, take that one step further, really wanting to look at what alpha is going to be equal to the amount of impact generated. We want to make sure we're not going to invest in something, even if it's really guaranteed to give us high financial returns, unless it is actively making positive strides in our community, we're not investing in it. And then you've got pure impact funds. This is when we don't care about, alpha. We are only focused on all of this money. We don't care if there's returns that are associated with it. We really want to make sure that impact is the primary purpose of what all of this money is put towards. And this is often things like endowments for nonprofits. So again, we have some data that was pulled from this investor survey that EY performed. So you can see here, ESG is something that's on people's minds, but we're seeing that larger corporations that have much larger portfolios are really the ones that are taking this the most seriously right now. And everybody else is kind of, it's on our mind, but it's not at the forefront just as yet. But hopefully that shift is kind of starting. But over $15 billion in their portfolio, you see that those individuals, 36% of them responded that we take ESG policy very seriously. We have a procedure, a process. This is something that we have made a priority in our organization. A lot of these organizations will have recently appointed an ESG head, someone who is actively, their role is focused on what is our internal ESG measurement metric process, and how do we ensure that our investors and our clients, everyone has transparency in what the ESG aspect of our company looks like. Then we've got kind of our $2.5 to $15 billion folk. That's only about 25% that are saying we're looking at it very seriously. And then we've got the under 2.5 billion. So this is going to be the majority of your funds that are very, very small. Those, only 18% are really looking at it now. But this information is from May 2022. Hopefully, as we move forward, we're going to see that light teal color expand across all three of these financial buckets. So what are the use cases? We're talking a lot about finance, but I recognize that a lot of people, both in the audience and online, may not be sitting in the financial services space. So you might be thinking, how does this apply to you? So here you can see three major buckets: growth, optimization, and defense. Growth, how do we grow our business as a result of ESG metrics? What can they do to help us get bigger? Two, optimize. How do we take our current operations and make sure that we are doing them in the most efficient way possible to ensure that both our talent and our clients are getting the maximum bang for their buck? And finally, defense. How do we protect against things like COVID or a war in Ukraine from impacting the value of our company and what our company is doing? What do we need to think about moving forward? And again, I'll let you kind of pause and read this later on if you want to watch the video. But as you can see, there really are a lot of use cases that don't just sit in impact investing or sit in the financial services space. This is across all industries. So now I'm going to hand it over to Harish, who will talk a little bit more about the data aspects and how your data can help you better value your company.
Wonderful. Thank you, Anisha. Brief intro, Harish Arora, part of our EY's technology consulting practice. I lead the technology and data strategy for sustainable finance. Anisha and I have been extremely passionate about this topic for a little over 3 years now, and super excited to share our ESG research, as well as the CDO imperative for the room full of CDO in this space. And I think before we dive deeper into the technology and data challenges and talk about a potential solution, let us recap everything that Anisha went through. What is ESG? Environment, social governance, easier to remember with a 3P framework. Environment is everything associated with our care for planet. The first P, which is your water stress, your air and water pollution, your greenhouse gas emissions, etc. The governance, the social is everything associated with the people, the human rights, the labor rights, the wellness of the employees. The governance is everything related to the principle of your business. such as transparency in the tax, transparency in your data privacy policies, transparency in the usage and consumption of the data, and your board diversity. Then we talked about what is impact investing. And if I may draw a quick time map for you, about 60 years ago or so, when the religious institutions decided to not invest their money in tobacco and firearms and alcohol, it started the era of ethical investing. Fast forward 40 years, people started to not just exclude and do the negative screening of those industries, but more specifically, companies that did not follow the social behavior, countries that enforced the labor practices such as child labor. And that became socially responsible investing. Now, more recently, the impact investing is about not just not doing the wrong thing, but intentionally doing the things right. And that's where intentionally investing in companies such as your senior housing or the low-cost housing and starting to build a portfolio around it. Then we briefly talked about the tangible versus non-tangible value of the company. Once again, taking you back about 80 years, majority of the market value of the company was made up of tangible assets, your physical assets, your inventory, your buildings, your IPs. Fast forward, now, based on multiple research and multiple studies, about 80% of company value is made up of intangible assets, which is your trademarks, which is your goodwill, which is your market reputation, which is the perception of your company in improving the societal and the environmental value. Now, let us link it all together with technology and data for the data leaders in this room. How does it all come together when you start talking about data challenges and resolution of that? We talked a lot about why. The way we have structured the rest of the conversation, we're going to focus on what are the set of challenges that we need to resolve, what are the set of technology and the data optionality that we need to start addressing, and then get a lot into details of how we can start to resolve some of those challenges. So starting with the set of ESG challenges, the very first one is associated with the ESG integration. And think of it as playing a three-dimensional chess in a parallel universe. So the example there is, there are two aspects of it. One, on us, and second, off us. You as an entity, you as a company, are receiving multiple requests coming from your clients, coming from your investors, coming from your regulators, needing to have a cohesive view of the ESG data. And how do you do that? Your social data is typically sitting in your customer relationship management system like Salesforce. It is sitting in your human capital management system like Workday, and multitude of the marketing applications. Your governance data, which is traditionally sitting in your ERP application or finance application or your payroll systems. Climate data for most of the companies, irrespective of what industry you are in, airline, manufacturing, financial services, has been almost non-existent. A lot of companies have now started to capture it as part of the onboarding of the client, onboarding of the suppliers, onboarding of the different manufacturers that they supply to them. So the first challenge, integrating the factors associated with environment, social, and governance all into one landscape to be able to deliver on the use cases such as client reporting, regulatory reporting, disclosures, and many other needs that are coming in. More recently, the SEC requirement to have the ESG attributes reported on 10K and 10Q filing. Now, the other dimension that we talked about, when you look at the parallel universe, is not just the ESG attributes associated with your company as an entity, but what about ESG attribute if you were an institutional lender like Citi or JP Morgan or Bank of America and lending $1 billion to water and beverage bottling company like Pepsi and Coke? You may be surprised to hear that some of the banks in UK have now integrated the interest rate associated with the water stress level of those companies. So it's no more a financial performance. It's no more talking just about if you're performing better financially, you get the lower interest rate. People have started to integrate the ESG into their day-to-day operation in alpha. In that parallel universe, the problem statements are very different because you would want to harvest the data for your suppliers, could be many. You would want to harvest the ESG data for your portfolio companies, which you may be investing in as an asset manager, as an asset servicer, as well as you would want to be harvesting a lot of that data from your manufacturer. And the challenge becomes different because if you have 20,000 branches, just understanding the usage of the electricity and how green that electricity is across your 20,000 branches could be potentially difficult. So with that, let's talk about the data challenges as it comes to provisions. Now, we have not made it easy. When you think about provision, it is the set of regulations, set of guidelines, set of frameworks, set of standards, set of disclosure. There are a little over 600 provisions just in the ESG space. And about half of them were created just in the last 5 years. And now, in an absence of a common standard or a provision that you want to report on, as a data officer, you do not have a contract of what data points and what data inputs you essentially need to harvest and capture to be able to do the disclosure reporting. Going further in data challenges, when we talk about these, the multiverse aspects of it, there are a little over 200 data providers. And they can be divided into 3 core categories. There's specialist data providers, such as CDP or the Carbon Disclosure Project, which is specialized, as the name suggests, in a common theme. Theme could be environmental, and within environmental, CDP focuses on the water stress, deforestation, and the greenhouse gas emission. Then there are comprehensive, a little over, I would say about 150 plus comprehensive data providers. So these are MSCI, Sustainalytics, and like. What they have been able to do, essentially integrate a lot of the data across E, S, and G themes collectively and provide a comprehensive set of the attributes to the companies, which essentially sits on the fundamental data set, which is coming from your self-reported disclosures, which is coming from your self-reported net zero alignment commitment and the statements that you make in media, as well as your 10K and 10Q filings. On the left, there are a little over 200 some data providers, but a fun fact, about 3 of them cover about 60% of the market. So when you essentially go that path, select one of the 3, you cannot practically go wrong. On the challenges, these data providers, unfortunately, are not yet standardized. When you look at credit rating agency like Moody's and S&P, they report between AAA and CCC. When you look at the FICO scores that you have been getting for your personal credit score, between a range of 300 to 850, has a divergence of plus minus 20, irrespective of what FICO score agency you go to. But when you look at the indices and the scores provider of ESG, they have a significant difference when it comes to the methodology. Their methodology sometimes produces a score on a AAA to CCC rating, sometimes from a AAA to B, sometimes 0 to 10, sometimes 0 to 100, and so on and so forth. And that creates a challenge of normalizing all of this data to be able to make sense out of it. Now, if that was not enough, there's also a challenge associated with the divergence of the rating. So let's say if your very smart data engineers were able to normalize all of the data and essentially bring it all together, remap AAA to 100, and essentially do the mapping, there is a significant divergence. Based on an article from Wall Street Journal, as you could see, for a company in this example, Tesla, the divergence in the environmental factor is all over the spectrum. it is no more plus minus 20 like your FICO score anymore. Rather, depending on what methodology is being used, it is throughout the spectrum. You might wonder why. And there has been a lot of research done, and I'm very, very proud to say the one research paper that has been referred multiple times was published by somebody here at MIT. It talks about 3 core challenges with causing the divergence. First one of that is about 60% of this divergence is caused because of methodology. About 30% or so is based on the underlying attribute that these different rating agencies are consuming. And about 10% or so associated with the weights that they're applying to each of those different themes and the metrics. To continue to make the matter complex, in addition to the data issues, the correlation challenges, the divergent challenges, there are also issues and challenges associated with a convoluted relationship. Now, this is a made-up example, but if you follow the graph through, and this is where a technology like Neo4j can play a major role, an event that potentially occurred in a mineral mine factory in Republic of Congo, which had a child labor incident reported by an NGO, which then supplies cobalt, as an example, to a EV battery manufacturer, which then supply those batteries to a company like Tesla, which then is rolled up in many portfolios because of the perception of the environmental impact that it is creating. However, that impact is now coming at a cost of a social impact because it is promoting a child labor. So really untangling this hairball and starting to make this network effect is extremely important to be able to make insightful decisions by your portfolio managers, by your investment officers. So let's recap everything that we went through so far. The data correlation, certainly we hit on multiple times, correlation because of the challenges and methodologies, correlation because of the different data providers that you use. But that is only the tip of iceberg. When you start to peel this onion, there are challenges associated with the lack of consistency of the data. And the example there is when you look at the public market, majority of the Fortune 1000 companies are already doing the self-reported disclosure, and it's easier to harvest, integrate all of that data. However, when you look at private market, a real estate building, a tall building in Chicago, a parking lot in New York, they do not have neither a framework nor a motivation to capture all of the data. And when that property becomes an asset, becomes a fund, and money gets raised into a portfolio, there's very limited way to go down and understand the ESG consideration associated with that fund. So consistency across public market and the private market, the challenges associated with granularity, not every country, not every framework expect or require for you to go into the same level of detail. Interconnectivity continues to be a challenge, that I can continue to gather these 8,000 different data points and start to integrate, but which UN sustainable goal, about 13 of them, that all of this data is being mapped to. What value impact that we are trying to drive. Frequency is certainly another issue where when you look at the genesis of a lot of this reporting is once a year. Some of the reportings are, again, on a self-reported basis done once a quarter. Some of the SEC filings are going to be a little more recent. But the example of the event that we just talked about, or a news leak in the media, or an oil spill, you would want an ability to be taking the action right now. So moving from an yearly old disclosure reporting as a foundation to driving the decisions, be it your investment, be it your supply and optimization, or any other use case that you're trying to drive, using more refreshed data. And lastly, the quality, and surprisingly, this is really working based on the system of trust. There is very limited assurance, audit, or attestation requirement associated with these disclosure reporting. Unlike a financial report that you publish out, which has to be signed off by an auditor, these disclosure reports are self-reported and really work based on the trust. So the quality of the data that you are consuming to make some of your investment decisions is as good as the quality of data that is being provided to you through those reports. So I think it will be extremely horrible of us if we leave you hanging with just those challenges and not potentially talk about solutions. So what we have been able to do is develop a set of frameworks to try to get you faster towards the answer. And once again, a lot of focus that we're going to have in the rest of the talk is around data technology architecture. So starting with this framework, where think of it in 4 different dimensions. A dimension associated with your ESG data providers, some of the key decisions that you'll need to start making around what ESG data providers that you want to work with, what is material to you, who can provide the most coverage depending on the geography and the industry that you work in, how much of the reliance that you need to have on the market data versus open, public, and alternative data sets. The second theme is around the ESG standard setters, or the provisions, as we talked about. And those provisions are not just the traditional disclosure reporting, what kind of partnerships that you want to have to continue to elevate the impact in the market, what kind of standards that you want to follow, what kind of regulations that you need to abide by, depending on the geography that you are doing the business in. The third is ESG technology, and this is where, no pun intended, it's an extremely polluted space. Over the last 2 years or so, there have been at least 200 different fintech, climate tech, ESG tech companies that have mushroomed out of nowhere, and all for the right reason. Some do a theme or a particular action really, really well, and some are more ecosystem player. So when you look at things like Microsoft, SAP, Salesforce, they are continuing to extend their capabilities to serve and deliver on the ESG needs. And some, such as N0 or Net Zero, are hyper-focused on helping you hand-to-hand and get you to your net zero commitment, such as 2030 or 2050, depending on the alignment that you have. And the last, all of it is so what, right? All of this to be able to drive and deliver the ESG business services or ESG use cases, which align to the materiality of your firm. What matters to you? Where do you want to start, right? The disclosure, the risk, the defense is certainly non-discretionary in nature, but things that are discretionary, people have started to leverage this as an alpha generation opportunity. So we'll dive deeper just really quickly into each one of these spectrums. The first dimension, as we talked about the different data sources, market data providers such as MSCI, Sustainalytics, and a few others have done tremendous amount of work in organizing, integrating data coming from the disclosure reports, coming from your alternative and open data sources, some of the third-party data providers, and have been able to essentially provide you a long record of a company. When you look at Apple or Tesla or Microsoft, you can get one good long record of the company coming from these data providers. However, everything is context. And to be able to drive that context, you will need to integrate a lot of that data with alternate data providers such as public filing. If you wanted to not just see what is your DEI score as a number, but what you as a company doing towards improving the DEI, you would need to essentially go back, peel the onion, read into the disclosure report. And this is where a lot of unstructured data processing come in, be it the news media, your disclosure reporting, your 10K filing. It all needs to be processed and consumed in a manner that can be integrated with the rest of the data ecosystem. The other example is the governmental agencies as well as the NGOs. We went through an example. This is where a lot of the data, such as if you wanted to understand how many immigrants do you employ in a company, to be able to go to USCIS, obtain that data, and integrate with your set of suppliers or your set of portfolio list of companies to try to get to that metric. Patent trademark office data is another great example. Your IP as a startup versus the IP of a mature organization. Then there are internal data assets. Obviously, this is on us data sets, and this is essentially what makes it significantly different. We talked about on us data coming from your CRP, your HCM, your SAP, as well as your Salesforce-like systems, and integrating that with your holdings, your products, your portfolio, your investment strategy, and like. Lastly, the client data set is an interesting and evolving area where we see that majority of the company now changing their client onboarding as well as the supplier onboarding approach. Previously, they were asking 5 dummy questions, such as, how much do you invest in water management? What do you do when it comes to the electricity consumption? And now we see those forms are growing as big as 500, 600 questions with an attestation of trying to understand what is your supplier's consideration when it comes to the ESG topics. Now, a similar framework around the ESG provisions. This is where, as we talked about, disclosure is becoming a little more common, when it comes to different or Fortune 1000 firms starting to report on that. Standards in this example are also the set of disclosures. However, this has the meaning outside of the financial risk and the financial impact. So TCFD, as the name suggests, are the climate disclosures, such as an impact to an insurance company as it applies to the transitionary risk of the green economy. Whereas the other standards like SASB, like IIRC, are more broad in nature. They do not just focus on the financial impact, but are also being used for the community outside of your investors. Taxonomy, again, depending on the geography, area, region that you do business with, there are already set of taxonomy requirements as well as the regulatory requirements, such as EU taxonomy, such as SFDR reg reporting, such as SEC filing in US, that all need to be integrated and provided. Lastly, the partnership, as we talked about, what partnerships such as carbon accounting framework that you would want to have. So now, starting with the problem statement and down to this framework and starting to select what matters to you, what is material for your business, what kind of partnership, what kind of disclosures that you would want to have for the investor community, as well as for your rest of the ecosystem. Going into the technology themes, we briefly talked about the ecosystem player, be it Microsoft, SAP, IBM, everybody is expanding their capabilities now to be able to help with not just the disclosure reporting, but also be that underlying data utility to integrate all of that data. Climate tech providers, hyper-focus, these are very thematic, very specialist. We talked about net zero. This is an example where their complete focus in trying to get you to the net zero commitment that you have made. Fintech providers, we see some of our clients using different fintech provider for the specific set of use cases, such as an investment manager, if I wanted to do the client reporting, picking one of these, certainly helps. Now, lastly, custom platforms, which is interesting because this is no more a play of building these systems or leveraging the technologies. We see the more mature players in the market monetizing this data. Example there is Fidelity's ESG Pro Score, which essentially leverages the data from the prior few pages that you saw from multiple different data providers, overlays that with the investment acumen, overlays that with the years of business acumen that they have been able to develop, and essentially creates a new score, as they call the ESG Pro score. Northern Trust has something similar, it's called Vector Score, and they have been able to monetize that information by giving it back to the investment management community. The last but not least is really the motherhood apple pie of so what. All of the selections that you made associated with the data, the technology ecosystem player, the provisions, are to deliver on the set of use cases. Now, this canvas may look different depending on the industry that you are in. Consider this canvas for a full-service financial institution doing the institutional credit, such as a $1 billion bond to PepsiCo, doing the consumer credit, both to the individuals as well as to the small businesses, doing the corporate functions like risk and compliance, supporting the financial functions, as well as optimizing the supplies and the procurement functions. As you could see, there are multitude of use cases, and ESG is one of the few things that kind of cut across the complete supply chain of a firm. Now, all of them essentially leading to some of the output that have to be produced and submitted, such as your 10K, 10Q filing, such as the stress testing, which used to be highly focused on the financial performance and is now required to include the climate risk, both transitional and the physical. Now, with that, let's get into a potential canvas of what an architecture may look like. Now, you may decide to develop a standalone ESG data utility or develop an ESG utility on top of your operational or analytical data platform that you may already have. There are 3 core components to it, 3 C's as we go by: capture, curate, and consume. To be able to capture the data, both data coming from your market data providers, data that is coming from your unstructured data sources, data coming at speed, data coming in the yearly batch mode, to be able to have those orchestration and the framework around it. Then the curate. Now, this is not your traditional data quality curation, rather talks about how do I normalize the data, as we talked about. How do I start to standardize the data coming from various different data sources? How do I take that data and start to calculate using my calculation engine for the submissions that need to happen for TCFD, SASB, GRI, etc. And lastly, the apps builder. This is your consumption part of it, or the consume. This is where a technology like Domo can play a role, where you need to be building various different data apps on top of it. And those data apps are significantly different depending on the use case that you're trying to drive. A data app required for me as an institutional client wanting to understand and make sure that my portfolio companies are abiding by the impact and the value standards that I have placed in, is required for the client reporting. However, another side of it, which is reg reporting, which is your risk appetite, your risk rating, your physical scores, are essentially different set of data apps, however, sitting on the same integrated data set. Now, if this was simple enough, let's go into a hairball and let's try to untangle. Now, as you see, a lot of this hairball effect is caused because of the orchestration that need to take place across multiple stage gates of the ESG data processing. Just touching upon a few critical ones. We already talked about the data coming from your market data providers, your open data sources, as well as some of the on us, your consumers, your prospect, your supplier data. The couple key things that we did not yet touch upon is one, the master data management. You might wonder, ESG and master data management don't seem to go along together. However, when you think about your, let's say Apple issued a bond, that investment instrument issued by Apple need to then be tied up to the Apple as a parent entity, because any and every ESG disclosure is only being done at the parent entity level. When you think about supplier, and we all know this problem where there are a little over 60 different combinations of IBM, depending on which geography you're buying them from, or are you buying a hardware versus software, or everything in between. So to be able to master the supplier. And that's one of the key pieces around the mastering, and a technology like Tamara can essentially play a role. The other aspect is the common data model, and this is your core data taxonomy to be able to bring together data from different market data providers, to be able to bring together data from the disclosure report, underlying data sources, and structure it in a common shape and form. Now, the intent there is not just to normalize, but also to label it so that as soon as the data is persisted, it can be used for various different use cases. And the last but not least is around the different business apps, as we talked about, such as your client reporting, your investment compliance, again, depending on the industry that you are in. This takes it a level deeper, and just very quickly touching upon the aspects here. The computation engine that you saw, the algorithmic engine that you saw, is not just about integrating all of the data, but also to be able to extrapolate a lot of missing data. This goes back to the trust factor that we talked about. A lot of the data that is available right now is all self-reported, and if you wanted to stack 5 different companies to be able to make the investment decisions, you would want to be able to extrapolate the missing data. So I think that if anything, we want you to take 3 things from this talk: the reward, the return, and the risk. The 3 are. The reward associated with generating alpha, growing your business, to be able to put new products in the shelves. An example of that is the Different Impact Fund. To be able to attract new customers. We have all seen this study around millennials wanting to put majority of their funds into the impact fund, and the shift from a goals-based advice to the value-based advice, as well as to be able to continue and improve the market share. The second R is around the return, which is where you can use ESG not as a defense mechanism, but as an opportunity to be able to improve the efficiency of the workforce, improve the efficiency of your operational supply chain, as well as improve your reputation as a business. And lastly, the risk management, which is your compliance risk, which is management of your various different regulations, which is management of your reputational and supply chain risk. So with that, I would say just one last thing, which is if none of this resonated with you, to be able to improve our E, S, and G and save our planet, I think there's one more way. There's one more way to avoid the global warming. And you can do that by changing your system setting to read the temperature in Celsius versus Fahrenheit. Thank you.
So Harish, thank you very much indeed. Anisha, thank you very much indeed. We actually have got almost 100 people online. Some of the questions they've asked online are really, really interesting. But first, I want to give the audience an opportunity. If you've got a question, please use the microphones up there. So you can go ahead and stand up there, and I'll see you up there. But in the meantime, while I give the courage online folks or on-site folks to stand up, let me read out the first one, got the most votes so far. And they say, isn't ESG data now just like pre-Lemon's CDO ratings? Nobody is publishing bad ESG ratings, i.e. greenwashing is still a concern. How do we validate the trustworthiness of the data?
I think that's a great question, and we try to throw some breadcrumbs along the way. It is certainly at this point in time is dependent on the self-reported data set and the system of trust. But a lot of applications, fintech, climate tech, have come along which are overlaying this data, not just from one source, rather different sources, alternate sources, other third parties, to be able to improve the quality. And I think it also ties back to a survey that we did to over 200 different chief investment officers. Almost every one of them rely on about 7 to 8 different data sources. And why so is not just to be able to validate the data coming from one provider to the other, but also to be able to pick the best, such as analyst node from one data providers and your thematic screening of a company from another.
Excellent. There was another question to come up. In your opinion, who decides what is sociably or environmentally responsible when there are widely different perspectives on this, especially when it can veer into politics?
Sure. So I think that is kind of part of what we're figuring out now. Those 600 plus different provisions, everybody's measuring and trying to quantify those environmental and social attributes in different ways. But the benefit of having a quantifiable metric that you are looking at is that you can then compare against others in your industry. Obviously, it's not fair to compare, an energy company's environmental score to one of a company that's in maybe the retail space. Like there's different things that you have to worry about depending on the industry that you're operating in, but being able to measure across different companies within a given space gives you that ability to look at apples to apples. But yes, it is definitely still a concern, trying to figure out what exactly are we measuring and how do we measure it. I think the environmental space has come the furthest in this, in the sense that they are quantitative metrics that are already there. Carbon emissions is something that you can put a number to. But the social and governance spots, I think there's a lot of different people that are currently working on trying to solve what is the best way that we measure those things, so it's not just, going back to the previous question, just greenwashing and saying things that make you look good, but actually meaningful information that you can use to compare companies to one another.
Excellent. This next question, someone's making an assumption here. Maybe you can either prove the assumption or not, but it says, ESG doesn't seem to take into account the amount and the nature of the waste products of a business. For example, battery manufacturing is measured, but is the disposal accounted for? Is this hidden in one of the 3 scopes?
And the answer to that is 100%. And there are multiple different parameters when it comes to the waste management disposal. There are set of parameters that focus on electronic waste. There are a set of parameters that talk about the water and the waste management and the recycling, et cetera. So there are quite a few parameters that essentially address that point.
Excellent. And just on the last question here, with such a long and complex global supply chain of goods and labor, is there an open data standard or super government body working towards harvesting or harmonizing data?
That's an amazing question too. And I would say, I think the first step in the race is to start to harmonize the different standards. And there has been a lot of amazing work done thus far. IIRC, as an example, or IISB are trying to integrate a lot of not just financial performance data as it relates to climate, but also for the broader set of use. So integration of the provision, and then comes the integration of the data. Once you have a standardized disclosure approach, once you have a standardized approach to be reporting all of your E, S, and G attributes associated with your business, it gets much easier to integrate all of them in one common shape and form. Right now, the lack of standardization, lack of those standards is certainly what is causing the complexity in the ecosystem.
Excellent. Harish, Anisha, as I say, this will become the standard. People will be looking forward to a lot of good content. Thank you very much indeed, and I appreciate you guys being here.
I think we have one question.
Oh, sorry, one more question.
Yeah, thank you very much. Terrific presentation, so comprehensive. It's great to see. Question is, given the intangibles that drive all of this, how are the budgets being defined to make the investment to do these things, especially looking at how complex the architectures can be, right?
I think that's an amazing question. I'll start, Anisha, add
Sure.
to it. It reminds me of a story when somebody was saying that what were the companies that survived the 2008 crash and the crashes before that? And those were the companies that did not just kill their innovation arm and did not just kill their approach to sustainability, rather optimize the overall supply chain. So to your point, all the mature firms are already looking at not just the tangible aspect, but the investments in the innovation, investments in doing good for the society, improving the health of the planet, continuing on that path, and those are the companies who will be the leaders in the years to come.
I think just to add to that, I think it's a top-down issue. You really need to make sure that the senior management is fully bought into this idea that this is something that you should be thinking about, and that's the only way that you're going to be able to make sure that you have the right talent working on solutions to this problem that are unique to whatever organization that you're a part of. So I think the companies that are investing in, an ESG executive, someone that not just is there as, to look good, but actually is integrated as part of the C-suite, is part of the discussions, is actively voicing their agenda, I think that's huge. And the companies that are doing it well are the ones that are going to come out on top as we move forward.
I like that, an ESG manager or director, whatever. Thank you for that question. Appreciate it. Thanks indeed for your time.
Thank you.
And you can go ahead and run the video.